Good evening and welcome to Qnews Economic Bulletin with me, Halal Hamalawi. In our bulletin, we bring you the latest top economic stories along with expert analysis on the events and trends shaping the regional and global economy. Throughout our coverage, we spotlight key sectors and highlight the defining economic developments of the moment. To start with the latest headlines, we hand it over to my colleague Rihem Morsi for the top economic stories. Rihem, what do you have for us today?
Thank you so much, Heather. We have a lot of news for you here today and developments from around the world. We start off with the latest updates of the hour as the World Bank chief economist, Intermet Gill, has warned that escalating hostilities between the United States and Iran could reignite inflation, drive up interest rates and sharply slow global growth. Gill said the bank's scenario projects global growth slowing to 1.3% from 2.9% last year, while headline inflation rises to 4.5% if the conflict persists. He warned that prolonged fighting could disrupt oil and fertilizer supply, worsening food insecurity and raising borrowing costs, especially for developing economies. While the United States, China and India have remained relatively resilient, Gill said poorer countries face the greatest risk. Moving on to Europe, where the Italian Finance Minister Giancarlo Giorgetti has stated that the government is cautiously optimistic that Italy's 2025 budget deficit will be revised lower, boosting hopes of exiting the European Union's excessive deficit procedure later this year. Giorgetti has said the current deficit estimates include the 8.4 billion euros in unexpected home renovation tax incentives, adding the figure could fall after some claims were found to be fraudulent. He said updated data due to September 22nd could result in a lower deficit forecast. Giorgetti also reaffirmed the government's 0.6% growth forecast for this year and the next. The Russian President Vladimir Putin has stated that the country's economy remains resilient despite what he described as external attempts to disrupt the fuel and energy sector, adding that recent volatility in the energy market was temporary and would not derail broader economic growth. He cited preliminary government data showing the economy grew 0.3% year-on-year in May, with the gross domestic product rising 0.2% over the first 5 months of the year. He also noted that the federal budget posted a 196 billion ruble surplus in June, supported by higher energy and non-energy revenues. He added that boosting investment and advancing structural reforms remains key government priorities. In the UK, the National Office for Statistics has reported that British inflation eased more than expected in June, helped by lower fuel prices following a temporary de-escalation in the Iran conflict. Consumer prices rose 2.6% year-on-year, down from 2.8% in May and the lowest and slowest pace since March 2025. Motor fuel prices fell for the first time since the conflict began, while manufacturers' input costs dropped 2% from the previous month. Food inflation slowed to 1.6%, while services inflation eased to 3.6%. Meanwhile, core inflation, which excludes food and energy, remained unchanged at 2.6%. Separately, ONS noted that British house prices rose by 2.7% in the year to May, after rising by an upwardly revised 3.9% in the year to April. Ireland's finance ministry has warned that an AI-driven correction in the US technology stocks could significantly hit the Irish economy due to its heavy reliance on the US tech sector. Under its baseline scenario, a 10% fall in the US equity prices would shrink Ireland's economy by 1.6% within a year, with investment down 4.5%, exports 2.6% and consumer spending 0.7%. Employment growth would also weaken as multinational tech firms account for more than 6% of the Irish jobs. The ministry said the impact on public finances could be significant, as the sector generates 17% of income tax and over 20% of corporate tax revenue. A 20% drop in US equity prices would reduce modified domestic demand by about 3.25%. Over to the African continent, Statistics South Africa reported that inflation accelerated more than expected in June, strengthening expectations that the central bank will raise interest rates for a second straight meeting on Thursday. Annual consumer inflation rose to a two-year high of 5.5% in June, up from 4.5% in May, while core inflation, which excludes food and energy, increased to 4.1%. Statistics South Africa said the transport sector was the biggest driver of inflation, as higher fuel prices linked to the Iran conflict pushed consumer prices higher. In Latin America, Bolivia's economy minister, Gabriela Espinosa, has revealed that the country is days away from securing an International Monetary Fund financing package worth between $2.5 billion and $2.8 billion. Espinosa said more than half of the funds are expected by early September and will be used exclusively to strengthen the central bank's foreign exchange reserves. He added that the IMF agreement is expected to unlock additional financing from other multilateral lenders, bringing total external funding to more than $5 billion this year. The minister further noted that the IMF has endorsed the government's economic program and its plans to reduce the fiscal deficit. Oil prices were approaching a 6-week high on Wednesday on mounting supply concerns as hostilities continued escalating between the U.S. and Iran, while threats to shipping by the Iran-backed Houthi militia in Yemen further boosted prices. Brent crude futures were up 2.54% at $93.32 a barrel, their highest in almost 6 weeks after hitting a session high of $95.47. U.S. West Texas Intermediate crude climbed 2.26% to $86.25. Both benchmarks touched their highest levels since June 11th during this session. Gold rose to its highest level in 2 weeks on Wednesday, buoyed by a softer dollar and technical buying as markets weighed signs of lingering tensions in the Middle East and awaited fresh cues on U.S. interest rates from the Federal Reserve. Spot gold gained 1.8% to $4,150.91 an ounce, having hit its highest level since July 7th at $4,141.59 an ounce earlier in the day. U.S. gold futures for August delivery rose 2% to $4,156.60. The U.S. dollar index softened on Wednesday, making greenback price bullion more affordable for buyers overseas. Elsewhere, spot silver rose 2.2% to $60.09 an ounce. In markets, global stock markets closed higher, with Europe leading gains as the U.S. and Asian markets were mixed. In the United States, the S&P 500 gained 0.16%, the Dow Jones Industrial Average increased 0.26%, while the Nasdaq Composite lessened 0.08%. In Europe, the UK FTSE 100 surged 1.24%, while France's CAC 40 added 0.89%, and Germany's DAX climbed 0.58%. In Asia, Shanghai Composite edged up 0.07%, Japan's Nikkei 225 declined 0.18%, and Hong Kong's Hang Seng Index edged slide 0.95%. Those were the top economic stories for the hour, and now we head back to Hala Al-Hamalawi in the studio to Hala.
Thank you so much, Rihim. Now we move on to our in-depth analysis. From Washington to Tokyo, government borrowing is on the rise. Fitch rating says that debt across developed economies is set to hit a record high by the end of 2026, renewing concerns over fiscal sustainability and the long-term cost of higher borrowing. Let's take a closer look. Fitch Ratings has warned that government debt across developed economies is expected to reach a record $75.8 trillion by the end of 2026, driven by persistent budget deficits, geopolitical tensions, and rising public spending. The agency forecasts debt will increase by $4.2 trillion this year, lifting the debt to gross domestic product ratio to 104%. Up from 68% 2 decades ago. The 10 largest developed economies are expected to account for $69 trillion or 114.5% of GDP, underscoring the dominant role of the United States and other major borrowers in global debt growth. Meanwhile, Fitch warned that rising debt levels are adding to fiscal and market risks. The agency expects the United States to record the largest budget deficit among major developed economies this year at 7.8% of GDP. France follows at 5%, Britain at 4.8%, Germany at 3.7%, and Japan at 3.1%. Fitch noted that successive shocks, including the global financial crisis, the Eurozone debt crisis, the COVID-19 pandemic, Russia's conflict with Ukraine, and the U.S.-Iran conflict, have fueled long-term debt growth and kept government bond yields elevated, despite easing from recent peaks. Looking ahead, U.S. debt is projected to reach 131.5% of GDP by 2030, while Japan's debt-to-GDP ratio is expected to remain the highest among developed economies at nearly 192%. And joining us now from Beirut to discuss the latest findings is Professor of International Economics at the Lebanese University, Professor Jassim Ajaka. Welcome, Professor Ajaka, to Q News. Sir, now Fitch projects government debt in developed economies to reach around $75.8 trillion by the end of 2026, or around 104% of GDP. What are the main structural factors driving this steady rise in public debt?
Good evening, ma'am. Thanks for having me. Before answering your question, in fact, we are witnessing the end, if you want, of the free money era, and we are starting an era where we have a structural fiscal insolvency, and this is across the Western world. When Fitch, in fact, says that really we will cross, in terms of debt, $75.8 trillion by the end of this year. This is just not, in fact, a big number. It's really, in fact, as you mentioned, it 100% of the GDP, global advanced GDP. So, if you want, the governments of the Western world, they treated, in fact, the emergency crisis spending as a permanent baseline. Instead of, once, for example, we finished COVID-19, instead of reestablishing a new, let's say, measures, fiscal measures, they continued with the previous measures. So it was like a permanent baseline, and with the high interest rates, addition to that, the defense expenses, and the aging population, mainly in the Western world, really, in fact, the fiscal buffer is gone. There is no more, in fact, fiscal buffer to do that. So, if you want, in terms of, let's say, bullets points, the first driver for this is the ratchet effects of shocks. Of course, we had COVID-19. We had also the Russian-Ukraine war, and we have the U.S.-Iran also war. So we have many shocks that really, in fact, impacted the economy and reduced, by consequences, the fiscal revenues of governments, but also it was mandatory to increase the interest rate, and by consequences, we have a high service debt. Also, we have, if you want, what we call the structural cost pressure. You have resulting of the geopolitical issues that we have. Really, in fact, defense spending increased in a huge way. In Europe, for example, we are speaking about 0.6% of GDP per year. But you have also the aging population and the climate adaptation, mainly in Europe. But also we have what we call the compounded interest expenses. And this, in fact, increased hugely that. Also, you have the interest rate trap, where many of the spending that were done in after the 28 global financial crisis are maturing right now or in the next years. So you need really, in fact, to borrow on the market to be capable, if you want, to pay this debt. Yes. So by consequences, at that time, we had something like 0% approximately interest rate. Today, we are at 4 or 5%. So you see that the debt service, in fact, is increasing with time, and this is very dangerous. So these, in my opinion, the main reasons behind this. Just to tell you that in 20 years, in fact, we tripled the global debt in Western world. We passed from 26 to 75.8 by the end of this year, according to Fitch. So yes. You see, the situation is a little bit complicated for that.
Yes. So why have governments found it increasingly difficult to reduce debt levels despite periods of economic recovery?
That's a good question. Really, in fact, most of the governments, they spent money really during the crisis, and by saying that, okay, we have an exceptional situation, so let's spend money, and later on we'll see how we can, let's say, pay this spending or to finance this spending. But they didn't do that. They continued, as I said, as a baseline, the spending as it is, and this is in fact accumulated the debt, and by consequences the service of the debt. Like you mentioned, the U.S. in the introduction, it's in a good example. We are at 2.5 trillion fiscal deficit. You understand that the situation will be very complex. If really, in fact, the Fed will increase the interest rate, they will have, in fact, a huge problem. The accumulation of the debt will increase in terms of growth.
Yes. Well, speaking of the United States, actually, the United States is expected to record a budget deficit of around 7.8% of GDP this year. So at what point does a persistent fiscal deficit become a threat to debt sustainability?
Let's split the topic into two different parts.
Okay.
You have the debts in the local currency, and you have the debts in the foreign currency. I doubt that, in fact, we have a problem in terms of, let's say, default of payments of US or even UK or France, because they are, in fact, the most of their debt, they are in their local currency. But the problem that, in fact, we will have a bankruptcy in terms of inflation. So the inflation will increase quickly, and this, in fact, is called also a debt erosion by inflation. So the value of the bonds that I'm holding or whatever it is, in fact, will worth nothing in this case. But this also, it could be a measure that maybe some governments will take by inflating the debt more specifically to erode it. So it's also a choice. But do not forget that according to a study dating from 2010, I forget the name of the economist. I'm sorry, but it states that in fact any inflation in the debts, any erosion of the debt by inflation will reappear in the future. And more specifically, it's the future generations that they will pay this debts.
Mm-hmm. And Professor, how do rising sovereign debt levels translate into higher government bond yields and increased borrowing costs?
If you want, here we have as I said in the introduction, the fiscal buffer is gone. There is no more fiscal buffer. So what the government has as choices, either in fact it could be financed by the central banks, welcome to the inflation, or by the markets. The markets will require mandatory higher rates, more specifically because they know that we have problems in terms of fiscal deficit. So they will require a higher interest. And in this case, we have, of course, a higher deficit and so on. So we are in we enter, if you want, in a circle where we cannot get out from it unless we have an economic growth. So there is a problem. There is a problem. And the geopolitical confrontations that we have today, they are, in fact, they play the role of a catalyzer of such issue. So that's why I do believe that we have a problem. But of course, the science, economics, give some, if you want, some solutions or some actions to do, of course, to avoid really, let's say, more complication in the situation.
Mm-hmm. If we take a look at the European countries, they are expected to increase defense spending in the coming years. So how can governments finance higher security expenditures without significantly worsening their fiscal positions?
They cannot, in fact, they cannot. You will see mandatory, you will see deterioration at the public services level, but also at the, let's say, other let's say, social spending. They are, in fact, they are constraints, if you want. You see the pressure that Donald Trump is putting on these countries to pay more for the military spending, their contribution to the NATO.
Yes.
Really, in fact, a dangerous future. If there is no economic growth to absorb really the weight of the debts by minimizing, if you want, the service debts, in my opinion, Europe will may have really, let's say, a crisis, a sovereign debt crisis, equivalent, or at least, I hope not, but to the crisis in 2012, when we had problems with Italy, with Ireland, with Greece, and so on.
Mm-hmm. Well, Japan's debt to GDP ratio is expected to remain close to around 192%. Yet, investors continue to view its debt differently from many other countries. What explains this difference in your own opinion, Professor?
If you want, Japan is a unique case. Is a unique case. Why? Because the vast majority of its public debt is held domestically by either institutional investors or even retail investors. And these, in fact, they are backed also by foreign assets. But however, even that, since that the Bank of Japan, the Central Bank of Japan, is mandatory forced, if you want, to normalize interest rates, any minor, even minor rates increase will create, in fact, an interest payments obligations for the Japanese Ministry of Finance. But let's say their situation is better than other countries at this level. That's why we are talking about 192% debt in terms of GDP. And even though they are in fact continuing with a normal situation, like in fact if it's less than 100%, but it's really the main reason is that in local currency and held by local investors.
Well, from Beirut, that was Professor of International Economics at the Lebanese University, Professor Jassim Ajaka. Thank you so much for your valuable insights. I'm Hala Al-Hamalawi. I thank you so much for following this special series. Thank you so much and stay with us here on Q News.